All right, so we're always told that financial markets are basically random, totally unpredictable, right? But what if that's not the whole story? What if there's a simple, super powerful trend that's been hiding in plain sight this whole time? Well, today, we're going to dive into a research paper that suggests exactly that.
You know, this is one of those questions that's right at the heart of all investing. Do prices just move randomly, with no memory of what happened yesterday, or are there patterns we can actually predict? For decades, honestly, the big dominant theory has leaned heavily towards randomness.
And that brings us to something called the random walk hypothesis. The whole idea is actually pretty simple. It says the next move in the market, it's a complete toss-up, a coin flip. What happened yesterday gives you zero, absolutely zero information about what's going to happen tomorrow. And look, it's a powerful theory, it's elegant, but what if it's just not the whole story?
So, let's get into it. Is Wall Street really just one big random walk? Because for a long time, that's what everyone believed.
Well, this is the exact question that a groundbreaking 2012 paper by Moskowitz, Awi, and Pedersen decided to tackle. They wanted to know if there was some simple, persistent pattern, a trend, that exists across pretty much all markets.
And what they uncovered, well, it's a phenomenon they called time series momentum. And let me tell you, its power and its consistency are, honestly, they're kind of stunning.
Okay, so what exactly is this strategy? It is shockingly simple. Seriously, you're not comparing a stock to other stocks or anything complicated like that. You are only looking at its own history. The rule is as basic as it gets. Just follow the trend. If the price has been going up over the past year, you buy it. If it's been going down, you sell it. That's it.
Now, to test this super simple idea, the researchers didn't mess around. They didn't just look at a handful of stocks. No, they went global. They went across all kinds of different asset classes, analyzing a whopping 58 different markets.
And I really want to stress, this wasn't some niche little study. We're talking about the whole shebang. They tested major stock indexes like the S&P 500 and the DAX, currencies like the yen and the euro, commodities like gold and crude oil. They even tested government bonds from the US and Japan, a truly massive, diverse set of markets.
So, the big question is, out of all those 58 incredibly diverse markets, in how many of them do you think this simple trend-following strategy was actually profitable? The answer is 58.
Yeah, that's right. Every single one. Just let that sink in for a second. Every single market they looked at showed positive returns from this strategy. It didn't matter if it was cattle futures or German government bonds. The trend was always there, a consistent, profitable signal.
Okay, now if you've heard of momentum investing before, I need you to pause for a second because it is absolutely crucial to understand this next part. This time series momentum is not the same thing at all.
So here's the difference, and it's a big one. The kind of momentum most people know about is called cross-sectional momentum. Think of it like a race. It's a relative game. You're buying the stocks that have done the best compared to their peers and selling the ones that have done the worst. But time series momentum, that's an absolute game. It's not a race against anyone else. It only cares about one thing. Is this asset's own trend, on its own terms, pointing up or down?
But here's where things get really wild. The most mind-bending discovery in this whole paper wasn't just that the strategy works. Oh no, it's when it works best.
The authors use this great phrase. They say the strategy has payoffs similar to an option straddle. Okay, finance jargon, right? So let's just break that down. All you need to know is that a straddle is a strategy that pays off big when a price makes a huge move and, here's the key, in either direction, up or down. It's a strategy that absolutely loves chaos and volatility.
And that's the crucial point here. This strategy doesn't just make a bit of money when things are going up. It made its biggest profits during the absolute most chaotic times. We're talking about market crashes, like the big one in 2008. Think about it. By simply following the strong downward trend, the strategy was betting against stocks and commodities, and it generated massive returns as everything else was collapsing.
And this is what makes it such a puzzle, you see. Most strategies that give you high returns also come with this huge risk of just blowing up when a crisis hits. But this one does the exact opposite. It actually works as a hedge for those crises. It protects you, and that makes its consistently high returns a massive challenge to all the traditional ideas about risk and reward.
All right, so if traditional risk can't explain these returns, what can? Well, to figure that out, the researchers dug into the data to see who exactly was on each side of these trades.
What they've found by looking at trading data was two main groups of players. You've got speculators and you've got hedgers. Speculators are the ones betting on where prices are going to go. Hedgers, on the other hand, are using the market to get rid of risk. Think of a farmer selling wheat futures to lock in a price for their crop. And here's the pattern they found. Speculators almost always trade with the trend. Hedgers trade against it. So what's really happening here is that hedgers are willing to pay a little bit extra for price stability. It's like an insurance premium. And the speculators are the ones on the other side, collecting that premium.
And this dynamic creates this really predictable life cycle for a trend. It goes something like this. First, a new trend gets identified. Then for the next year or so, it just keeps going, with speculators riding that wave and pushing it along. But eventually, after about a year, the trend starts to lose its steam and begins to reverse, which is right around the same time the speculators start cashing out and reducing their positions.
So the conclusion from the data seems pretty clear, right? It looks like speculators are consistently positioned to profit from this whole trend-following thing, and that profit is basically being paid for by the hedgers who are on the other side of the trade. So when you step back and look at all of this together, what we're left with is a really profound puzzle, one that gets right to the core of how we think markets are supposed to work.
Let's just recap the pieces of this puzzle. First, you have a dead simple strategy that somehow works everywhere. Second, it's most profitable during market crises, acting like a shield when you need it most. Third, it seems to fly in the face of the whole random walk theory. And finally, it all seems to be driven by this constant dance between the speculators and the hedgers.
And all of that leaves us with one last massive question. If a trend this simple, this powerful, and this profitable has been hiding out in the open this whole time, then how efficient are our markets really? Is this whole thing just a behavioral quirk and help people trade? Is it some kind of weird risk premium we don't understand yet? Or is it something else entirely? The paper doesn't give us the final answer, but it sure forces us to ask the question.